Welcome to Oregon Cash Flow Pro. My name is James Barber. As always, I'm here to help you maximize your cash flow. Today, we're going to be talking about whole life insurance, policy reviews, live illustrations, and actually, today, we're going to be going over one of my policies. So we've got an update on it. Our anniversary just happened, and we're going to take a look and see where that's at after a few years. After it's been enforced for a few years. How's it doing? We'll see if we can do an Inforce illustration while we're on here today as well. The policy that we're going to be going over is a policy that I have on my wife. Actually, I think she's the owner of it. And it's with Guardian, and we're going to see how that's doing. So appreciate you joining us. My hope is that by providing as much transparency around products, product designs, illustrations, policy reviews, is that you're going to learn everything that you need to know to make sound financial decisions with regards to high cash value life insurance products. Whether you buy those from me or somebody else, it doesn't really matter. Our goal here is education. So you can certainly sign up for a meeting with me if you want to see anything in particular specific to your situation. You can do that at my Calendly, which is on my website. You can see a link to that on my website. The website is OregonCashFlowPro.com, and you can see a link scrolling along the bottom of our screen here that has my Calendly link right there. So Calendly.com/cashflowpro. And we do one-on-one consultations there. It's a great place to get specific questions answered for your situation and look at illustrations that are built on what you want to see. Let's jump into my policy. So I haven't reviewed this yet. I just pulled up the information. I made a paid up additions payment yesterday, and so it just registered. I maxed out for this following year. Let me show you what we're looking at. Here we go. So this is my wife's policy. You can see her name right there. This is a Guardian policy. We make payments of $512.50 each month. That's our base. That covers the base whole life of the design and the cost of the term insurance that we have blended in with this. So we have a total of $2.15 million in death benefit. Now there's a loan outstanding, so that's why this is the net death benefit right now. Okay, we've got an outstanding loan right here. And then we have our cash value. This is what it looks like from the client side. Okay, now I can go in here and we can look at the details, but those don't really matter to us much. What matters is this. What's our cash value? If I wanted to walk away from the policy right now, I can't take this because I have a loan, but I can take this minus the loan, minus whatever interest is already owed on my loan. Okay, but this is our cash value. Generally, your cash value is your surrender value if you don't have any loans. If you wanted to, you could just take that cash, walk away. You might have to pay taxes if there was gains on it. Okay, so that's the base of our policy. Now, let's look at this from the agent side. We're going to get a lot more information here. And I did figure out how I can black out some important stuff, which allows me to be able to share this all with you without concern that this is on the internet. Okay, so this is a report that I can generate as the agent on this policy. And we can see this is the same policy. This is our base amount here. So $6,000 is our base. Remember, my monthly payment was $512.50. That's this plus the charge for doing monthly payments. So we pay an extra, $60, $80 over the course of the year to do monthly payments on the base and my scheduled paid up additions, which also includes my 1-year term insurance. Okay. Our base face amount of whole life insurance, $321,000. We've got some death benefit from our dividends. We're paying for $668,000 in term insurance. That's a cost of $588 for this year. Okay. And then we have over 1 million in paid up additions that we've already generated. Okay. And then we have a cash value associated with those paid up additions. Because of the design that we do, all of our early cash value is here in these paid up additions. That is by design. Moving down, there's our total death benefit, 2.1 million. Okay, then we have our basic cash values, which when you add these two together, adds up to right here, the 7,900. And it's showing that as of our next policy anniversary. So this is how much it's going to grow this year. Okay. Here's our outstanding loan interest. Guardian withholds it. It's prepaid interest. So it's a loan interest in my policy. It's a 6% loan interest. But because they withhold it at the beginning, it's like 5.6, something like that. It's not 6%. It would be 6%. It's the equivalent of 6% if they charged it at the end of the year. But because they charge at the beginning, they charge you a lower number. Okay. This is our outstanding premium. This is our next month's payment that gets made. So that's our $512.50. That's going to be coming out next month. Here is our total values. Now, one of the things, if a client reaches out to me and says, hey, how much space do I have available to put into my policy before I MEC? I'm going to look to this spot right here. This is our max unscheduled EPUA payment before MEC. Now, I'm maxed out for the year, so it says 0 for me. Okay. We can look at the previous year's cost of insurance. So it was $832 last year. What is it this year? $588. Okay, that's because I made paid up additions payment. I made a paid up additions payment. It reduced the amount of term insurance that we have to pay for. So even though this is annual renewable term, she did get a year older, our cost of insurance went down by quite a bit because we're paying for less of it. That's how the Guardian term insurance blend works. Every year, as long as we're max funding this thing, the amount of term insurance we're going to need to be paying for goes down. And the cost of it should go down, unless we're at an age where the cost of it goes up more than we've paid it down, right? But with our plan, the way it's currently set up, this term insurance is going to be gone within the next couple of years. I think 3 more years. So you can see we started this policy March of 2020. So we've made a 2020 payment, 2021 payment, 2022 payment, and we just made our 2023 payment. Now, what we're looking at is the totals after right immediately after my 4th payment. We're almost at a break even. You can see our policy cost basis was $289. And remember, our value was $279. Cash value was $279. So we're off by about 10 grand here, but realize I just made 60,000 plus in paid up additions payments. And those come with a load fee that takes some right off the top. So prior to me making those payments, I was like right at break even after the end of my 3rd year, right? 2020, 2021, 2022. So right at the end of my 3rd year, I was really, really close. I'm just behind my break even. But because I made my paid up additions payments, it makes it look like we're a little bit farther away because we're not going to get credit for those till the end of this year. Does that make sense? Drop me a comment if everything is making sense so far. And if you have any specific questions with regard to what we're going over. So you can see our monthly modal premium, the billing class, that's Guard-O-Matic. That's what Guardian calls their monthly payment plan. My last transaction just happened. You can see that right down here. So I made a paid up additions payment of $46,000. So I made 2 payments. I made a payment of $20,000 the day after my policy renewed, which was on the 1st of March. And then I just made another one $46,498. And that maxed us out for the year. Okay. We've got a loan outstanding of 162, and we've got a loan available of just over 100,000. Okay. Here's that loan rate, 5.66%. That's because it's paid in advance. Now, current people who are buying Guardian policies, the loan rate is 5%. And that's a fixed rate. It doesn't change. So what their number would look like would be more like 4.66 right here, because it's charged ahead of time. There's our loan payoff. So current outstanding loan, we have a little bit of interest that's accrued already. Okay. If we wait till the end of the year, this is the amount of interest in total that we'll pay on that loan, assuming the loan balance stays the same. Now, the loan balance could go up, could go down, depending on what goes on throughout the year, and this number will change. Okay. But this is the amount that they withheld based on this and what that would cost for the whole year. Okay, then we got our paid up additions. So we can see I made a paid up additions payment of $46,000. That bought us $189,000 in death benefit. That's a paid up addition. That's like a little miniature life insurance policy that we just bought. That $189,000 reduced our term insurance by $189,000. That's why our cost of insurance is a couple $100 less this year than the last year. Okay, so the total 1 year term that we have now, $668. That should match right up here. $668. Okay, so that's all that we have left to replace. So at $668, that's what? Let's go back here. Just over 3 more years of paid up additions payments. So that means I'm going to have all of this term insurance gone and replaced by permanent paid up additions in our 7th year. So 3 more payments, maybe just into the 4th one. Now, when I set up this plan, this was pretty cool. When I set up this plan, my plan was I set it up with a $5,000 base. Let's go back up here. Here's our base, $5,000. Now we know, if you've been paying attention to our videos, you've been looking into Guardian, you know, our designs that we try and do is a 10-to-1 design or a 9-to-1 design. You put in $5,000 for a base, but you can put in $50,000 for the year. Well, if we add extra death benefit, because of how Guardians works, if we add extra death benefit, we can pay in for longer number of years before that term insurance burns off. If we add more term insurance, we can pay $50,000 a year for more years. So I had this policy set in our original design that I was going to pay $50,000 a year for like 13 years, something like that. I don't remember the exact numbers. It was 4 years ago or three years ago, right? But our MEC limit is based on the death benefit. And if we increase the death benefit in order to pay more years of $50,000, our MEC limit goes up. In Guardian's current practices, they will let you pay up to the MEC limit. If you send in the money, they will accept it without you having to go through underwriting. Pretty cool deal. So what I've been sending in has not been $50,000. I've been sending in $72,000 a year. I've been making the $6,000 payments and then $66,000 in paid up additions. And they accept it, even though that's clearly more than 10 times my base. Pretty cool. So I'm burning this term insurance off faster than the original plan that we had. So rather than 13 years at $50,000, I'm going to end up at 7 years of $72,000. Ultimately, I'm going to put in less money, but because I got my money in sooner, the cost of that term insurance went away quicker. I get more years of compounding on those dollars because I got it in sooner. And I should end up with a more efficient policy. Now, I believe we did a review on this policy last year, and we were ahead of our illustration, slightly ahead of our illustration. So we're going to see if we can do that again today and see where we're at. We should be slightly ahead of our illustration still. Up here at the top, this is some of the other illustrations that I've done on this. This one right here, number 11, this is the last Inforce illustration I did. So I think this was last year. I've made a paid up additions payment. I mean, we've paid some extra. Up here at the top was a final illustration. So that was like our original. Okay. That was the original, which is like your minimum funded design. Okay. Not a maximum funded design, minimum funded design, which we turn in to get approved. So our cash value over here, we can look at projected cash value at age 75. This would be like if I minimum funded this policy. If I never put in any extra paid up additions, I wouldn't have hardly any cash value. The plan right above that does have our normal plan that went along with it. And you can see what our cash value projected to be. So this was when I started the policy. This was essentially a max funded design when we started the policy. By age 85, I was projected to have just over $2 million in cash value. Okay. That was remember, 13 years of payments of $50,000. Well, we've been accelerating that. We've been paying more than that sooner. And ultimately, we're going to end up putting in less money over the course of that time. So we're not going to put in for 13 years. It'll be slightly less dollars, total dollars that we put in, but it'll have more years of compounding. And here's been the reality. So last year, I didn't put a date on it here. I should have, but this should be last year. The projection was up to 2.25 million by age 85. Now I've accelerated that even farther by dumping in money this year. And now our projection by age 85 is now 2.3. So we've been increasing the projected payout because we've accelerated what we've put into the policy. Okay, so let me turn this into a PDF and we'll go through the PDF. Let me bring this back down. And I'm going to see if I can pull up. I don't know if I have an original PDF, but I might have the Inforce illustration that we did the last time. I'm going to have to take a look at my records. I didn't do a good job when I first started this of saving those illustrations. And I can't go back and reprint them because it's an old product. I can't go back and recreate them with what it would have originally been. So unfortunate, but that is the situation we find ourselves in. Okay, so here's our Inforce illustration. You can see it says Inforce. Our relevant values. This is the expected funding. Now I'm limited. I can't put in what I'm actually going to fund it at. So we should still continue to see these numbers get better. You can see we burn off that term insurance here, and then our death benefit starts to go up. At this point, this death benefit is made up of all permanent paid up additions and our base whole life. There's no more term insurance tied to that. And this is our projected cash values. Now we're going off the current, not the guaranteed. The guaranteed assumes no dividend payments ever, okay, from then on. It still continues to go up. That's why we get whole life. That's why we like whole life. We're going to get that guaranteed growth. When the market was crashing last year, I didn't worry about it at all because my policy is still growing, okay, by a guaranteed amount. And our dividend rate actually went up from 5.65 to 5.75. Hopefully we'll continue to see that happening. These higher interest rate environments, not good for a lot of businesses, but it is good for the insurance business. So we should see these the dividend rates continue to creep up. let me see. I'm going to leave this up here. You guys can watch that. I'm going to see if I can find an older Inforce illustration on this policy. I do have an illustration from February of 2020. But this might be the original, not a max funded. Let's see. This does have the full first year. Does it have each year? No, it doesn't. This is not our max funded design. Let's see. Let's get to the meat of this illustration. Yeah, this just has 50 for the first year. Bummer. This is not the max funded design. This is our minimum funded design as we started the policy. So clearly we're doing better than what this one projected because we put quite a bit more money into it. So let's get rid of this. I'm looking for you guys. I did save a max funding for my policy. When we get to my policy review, my anniversary date isn't for a little while. But when we get to mine, we'll be able to look up the last one. I guess today is going to be kind of a bust. We're not going to be able to compare this. But this video, I will put this out here. We're going to have this. So we'll be able to follow up in the following years. We'll keep track of it, and we'll have this up there. And I am saving these Inforce illustrations. So we'll just save this as is, and we'll come back to it in the future. But as for now, we're going to just have to go with what we got. We've got our current Inforce illustration. We saw that it was the cash growth was projected to be higher than what it was last year when we did our Inforce illustration, but I didn't save the stinking thing. So any questions from you fine folks out there? Any questions with regard to what you saw as far as projections that we're doing, funding questions? If you have any questions and you're not on this live one, put them in the comment section. I always answer every comment, every question in the comment section that I see. And sometimes I turn those questions into videos as well. So if you have some questions, that tells me that there might have been something that I missed when it comes to going over this stuff. And oftentimes it might make for a good video because other people are probably interested. Other people probably have the same questions that you do. I'll just finish scrolling through this illustration so that we have this on record with all the actual numbers. There we go. So there's our actual numbers. I think we'll call it a day for this one, but we're going to be back Tuesday for IUL, live illustrations or policy reviews. Next Thursday will be whole life again. And as my policies come up for renewal, I'm going to do my policy reviews. So I think next Tuesday on the IUL illustration, I think it's time to look at my national life policies, do an updated review on that one. Coming up soon will be my Mass Mutual policy renewal. And then later on this year will be my Guardian policy renewal. So we've got that to look forward to. So I appreciate you guys joining me. With that, we're going to call it a day. We'll see you next time. In the meantime, check out my videos on my channel. We've got so much good information with regard to all things cash value, life insurance, ideas on how to help fund these things, dynamic banking, infinite banking, you name it. We got some information on it to help you maximize your cash flow. So thanks, and we'll see you next time. Hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time. Now go maximize your cash flow.